In this short video, you'll see the impact on a stock portfolio from a shift in an underlying benchmark index. The aim of this video is to view contrasting impacts between an equal-weighted portfolio and a beta-weighted portfolio. Beta measures the sensitivity of a security to an underlying benchmark, such as a stock index, while calculations are made from daily returns over the past 2 years. Stocks that are sensitive to the performance of the reference benchmark have a high beta, while stocks that move relatively less have a low beta. Using the IB Risk Navigator, from the Metrics menu under the Beta Risk elements, select Beta, Weight, and Weighted Beta, adding them to the display. In this portfolio of stocks, you can see the dollar amount invested is approximately equal. To change the chosen reference index, use the Settings menu and select from available items in the Beta Reference Index selector. In this case, I'm using the S&P 500 index. By displaying the portfolio according to a high to low beta sort, you will also be able to contrast the dollar weight to the weighted beta reading. To sort, simply click on the beta column header so that it displays a red arrow pointing downwards. The raw beta reading describes the under or overperformance of the stock to the index. A beta of 1.0 implies that the stock moves exactly in line with the index. More specifically, the stock's return historically is the same as the return of the index. A stock with a beta of 2.0 both rises and falls with 2 times the return of the index. A beta reading of 0.5 infers that the stock rises or falls at half the return of the index over time. High beta stocks carry greater weight in the portfolio. You can view the expected change in the value of your portfolio from the plot viewer, selecting either beta weighted or equal percentage move aggregation. The equal percentage method will calculate the expected impact on the portfolio should the reference index move up or down using the weight of each stock. By contrast, the beta weighting method projects expected profit and loss given the composition of stocks and their historic performance relative to the benchmark. We can review this concept by looking at a portfolio of just 2 stocks, Microsoft and IBM. Note that it is possible to edit the beta value by simply typing your own value in each field under the beta column. Red font denotes user input values, while black font shows system-generated betas. By assigning a 0.5 beta for IBM and a 1.5 beta value for Microsoft, we can contrast the impact on a portfolio and at the individual level for both equal-weighted and beta-weighted measures. We can contrast what happens under each scenario. For the equal-weight portfolio, the IB Risk Navigator assumes a synchronous increase of 10% for both MSFT and IBM. The beta-weighted portfolio value change assumes that each stock rose according to its beta, such that IBM added 5% for a 10% gain in the index, while Microsoft rose by 15% for the same change in the reference benchmark. Understanding these alternate methods for portfolio monitoring purposes is important to risk managers. An equal-weighted plot most accurately represents occasions when the market moves as a whole, such as during a large market dislocation. A beta-weighted plot better reflects the day-to-day statistical variation of the market prices. Finally, you may change the time period of beta calculation, whose default time period is the last 2 years. Access from the Edit drop-down menu and select from choices of either custom or date interval range. The custom horizon allows users to determine the number of years, months, or days. The date interval allows users to select specific start and end dates. Each allows users to drive the calculation using daily, weekly, or monthly computations. Thanks for watching, and remember to look out for more short videos on IB's YouTube video channel.